I hope we get some time to entertain audience questions as well. So there is a possibility that some of the questions we may skip. Just take one more minute until everyone takes their seats. If you could sign off when it is a good time to start, please.
Yes, sir, we can.
Good evening, ladies and gentlemen. Welcome to Mishra Center's panel discussion on real estate investment trusts, or REITs hereafter. On behalf of Dr. Abhiman Das, the chair of the Mishra Center of Financial Markets and Economy at IIM Ahmedabad, I welcome you all to this exciting event. Mishra Center is a center of excellence at IIMA, supported by generous industry leaders. We attempt to spur the right dialogue at the right time to influence public awareness and policy measures. The center takes up research on various facets of financial markets, and we have a long list. Today, we are going to focus on real estate. In addition, the center has researchers who specialize in fiscal and monetary policies and many other topics of applied interest. Today's topic, of course, focuses on real estate markets in India, an area that has attracted disproportionately scant attention from the scholarly community. And some of our guests today will attest to this. At IIM Ahmedabad, we are working to bridge the gap and have recently ramped up our efforts to build a hub of empirical real estate research, education, and dialogue. You should soon expect some executive education modules on real estate from IIM Ahmedabad. If you have specific suggestions or requests, please do write to us. My email ID can be found on IIMA's website. I am Prashant Das, your host for tonight's event, an associate professor of real estate in the finance area and a member of the Mishra Center. Several people have contributed towards tonight's event, but I would still name a few of them. Thank you, Rama Kundanani, Mukund Krishnan Kumar, and Nisha Vijayarania of Brookfield, Riddhi Majitia, Nikul Solanki, and the marketing team of IIM Ahmedabad. Tonight's event is being co-hosted by my good friend, Dr. Vivek Shah, the director of the Lead Center for Real Estate at Lee Business School, the University of Nevada at Las Vegas. Dr. Shah has published numerous papers in leading real estate journals and has earned several research awards and serves on several editorial boards. He has been quoted in leading newspapers and radio channels of the US for his expertise in real estate markets. He earned his PhD from the Georgia State University, Atlanta. Go Panthers, Vivek. He earned his MBA from IMT Ghaziabad and BTech from NIT Rourkela. We are very privileged to be joined today by two industry leaders in the area of REITs. Allow me to introduce Mr. Alok Agarwal, the CEO and Managing Director of Brookfield Properties. As you know, Brookfield REIT is one of the earliest REITs in India, definitely one of the three pioneers, with a market cap well above $1 billion US. And Mr. Agarwal manages it from the helm. Alok brings his deep experience in real estate industry to this panel. Before Brookfield, he was the CEO of a private equity real estate fund with assets just under $500 million US. Earlier, he served on senior management roles with several real estate firms in the private equity and development spaces, including Sun Apollo Real Estate Advisors, DLF, TCG Real Estate, and Mahindra Life Space. He holds an MBA from ISB Hyderabad and a BTech in Civil from IIT Delhi. Welcome, Alok. Vivek, if you could please introduce Mr. John Wirth. Talk to John.
Thank you, Prashant. Welcome, everybody. And good evening, good morning over here. It is my pleasure to introduce John Wirth, joining us from Washington, D.C. It's morning around 8:40 over there, 5:40 my time. John is the Executive Vice President for Research and Investor Outreach at Reit. In his capacity, he leads Reit's internal and external research efforts and directs Reit's investor outreach and education initiatives. Reit's research focuses on the role of REITs and real estate in diversified portfolios and commercial real estate market dynamics. The investor outreach program brings Reit's research insights to US and global institutional investors. Prior to joining Reit, John founded the Office of the Chief Economist of the National Credit Union Administration, and he was there from 2010 to 2015. Prior to joining NCUA, John spent nearly a decade at the US Treasury, where he served as the director of the Office of Microeconomic Analysis and served as acting Deputy Assistant Secretary for Microeconomics during 2008. John has also worked as a consultant for Welch Consulting and the Rand Corporation. John is a graduate of George Washington University and holds a PhD in economics from University of Southern California. John, welcome to this program, and I really appreciate your time that you have shared with us in enlightening us about the role of Reit, a very unique organization, and the role Reit plays in basically supporting the REIT industry here in the US. So John, welcome. The show here. The floor is yours. Please go ahead and kind of give us some kind of insight into your role about Reit and the REIT industry in general.
Yes, good evening, and thanks for having me, and thanks to the center for hosting this event. I think it's going to be a great opportunity to have some discussions about commercial real estate, the role of commercial real estate in portfolios, and the role that REITs can play, and we'll talk a little bit about how Reit has, I think, played a role in supporting that development in the U.S. And so before we get into that discussion, I'm gonna share a few slides and talk a little bit about the growth of REITs around the world, and some of the reasons for that growth around the world. So I think you can see my screen now. So I'm gonna first just talk a little bit about if I can forward my slides, just talk. So who is Reit? What are we? And Vivek and I will get into this in a little more detail later. But Reit is a nonprofit organization, and we're funded primarily by dues-paying members. Virtually every REIT in the U.S. is a member of Reit. So our membership has a combined market capitalization today of about $1.5 trillion. So we represent the full breadth of the REIT space in the US. And we view ourselves as the representative voice for REITs and listed property companies worldwide with an interest in US markets. And one of our real goals, and this is a lot of what my group does at Reit, is to be an objective source of information about real estate markets and investing. And we'll talk about this more later, but we talk to institutional investors around the world about commercial real estate markets and about REITs. And one of our real goals in those conversations is to make sure that when we have a discussion, that everything we say, we can provide data or point to data and rigorous empirical analysis that backs up what we're saying. Because what we want to do is not convince people about the appropriateness of REITs in their portfolio for one day. We want them to become long-term REIT investors, and that requires them going and doing their own research, being able to do the analysis in their own organization and come to the same conclusions that we're coming to, or at least understand why we're coming to different conclusions. And so we want to be part of a long-term conversation with these investors that provides a robust framework for their using REITs as part of their real estate allocation. So one of the reasons I think REITs are an incredibly exciting point is because of this map that I'm showing you here. REITs have been in existence for just over 60 years. The first REIT laws were passed in the US in 1960. Frankly, between 1960 and 1990, very little happened in the US. In 1990, as I'll show you later, REITs had a total market capitalization of about $10 billion. We've seen a dramatic growth between 1990 and the present, where today REITs in the US market capitalization is about $1.5 trillion. And we saw an explosion of growth in the 1990s in REITs, really started what we call the modern Reit era. Over that same period, we've seen a dramatic spread in the REIT model across the world. So as you can see, REITs have spread dramatically through the 70s, 80s. Through the 90s and through the 2000s. Today, if we look at the spread of REITs by a couple metrics, we can see that the GDP share of countries and regions with REITs is about 85% of global GDP. And even more important and exciting is that when we look at the population of REIT countries and regions, today we can see the combined population of countries and regions with REITs is nearly 5 billion people. So approaching 70% of the globe's population. And one of the reasons I find this incredibly exciting is that I think REITs can be a really important tool as we see the globe continue to urbanize, and we see the world's cities getting larger, and we're going to see a number of new cities in the globe that leap into the top 10 and top 20 and top 50 in terms of the world's largest cities as we see increased urbanization around the world. And that is going to require an incredible amount of capital to create that built environment for the people of the world who are newly urbanized to live, work, and lead fulfilling lives. And REITs can be one of those sources of capital. And one of the really important things about using REITs as one of those sources of capital is that it creates a much broader ownership base. So, for example, today in the United States, about 44% of households have REITs in their portfolio. That's over 145 million people living in those households. When you compare that to broader stocks, it's only 50% of households who have stocks in their portfolio. So REITs have really spread dramatically, allowing most households who have private retirement savings to have at least some toehold into the commercial real estate market. Of course, we have a lot more work to do. We'll talk about that. But we think REITs have been a really important piece of this puzzle in terms of getting a broader, more diversified portfolio into households. So with that, let me step back and just talk a little bit about what are REITs, just so to set the stage. So REITs were, as I mentioned, were authorized in the US in 1960. And really the goal was to democratize the ownership of commercial real estate. That is to provide investors of all sizes with access to the investment returns, diversification opportunities, and dividends that real estate can provide. So a REIT itself, a real estate investment trust, it's simply a company that owns or finances income producing real estate. In the US, most REITs are corporations like any others. They're traded on the stock exchange. They can be bought and sold like any other stock. One of the things we like to say is that REITs house the US economy. They own the real estate where we live, work, and play and spend our leisure time. And we've seen, as we'll discuss, a dramatic growth in REITs, not only in the traditional real estate sectors, but also REITs have really been innovators. They've been the first into the market in terms of bringing institutional capital into a number of different sectors of real estate. Today, the most obvious of those are data centers, cell phone towers, integrated logistics facilities. But there's a long history of REITs innovating by property sector, including self-storage facilities, healthcare facilities. REITs have really been kind of the first into a number of these institutional asset classes. And that's one of the real investment attributes that REITs bring today. So in the US, we have some REIT requirements. The rules get quite complicated, but so the key is that the REITs must be widely held. They have to be held by shareholders. They must primarily own or finance real estate. That's really the key. They have to be invested in real estate for the long term. You can't flip your portfolio quickly. And then most importantly, they have to distribute their earnings to shareholders. In the US, REITs have to pay out at least 90% of their taxable income in the form of dividends. Most REITs pay out 100% of their taxable income, often more than 100% of their taxable income because of differences between the rules of what is taxable income versus what is accounting income in the US GAAP, globally IFRS. And that payout of the dividend to the shareholders has been really important in sort of defining REITs as being an income generating asset class, but also in terms of developing and generating really strong corporate governance. Sort of if we go back to sort of the principles of finance of what provides strong corporate governance, it's giving your shareholders access to cash flows. In the US, because REITs are paying out dividends regularly, they're also going to capital markets regularly to raise capital to grow. And that gives shareholders an opportunity to vote with their dollars, with their feet, as to whether they want to participate in the growth. And that provides, I think, the strongest corporate governance that you can get. So let me just briefly talk about why REITs matter. And I touched on this before, but REITs matter because they really help a much broader set of investors get access to a much broader set of commercial real estate. So when we look at the US investment market basket, what we find is that commercial real estate accounts for between 14 and 15% of that investment market basket. Commercial real estate is about $17 trillion in size. We estimate. We've actually just updated this estimate, and it's now closer to $20 trillion. And like I said, it accounts for between 15 and 20% of the investment market basket, along with equities, bonds, and cash. So what that suggests to us is that in a fully well-diversified portfolio, we should expect to see commercial real estate somewhere in the teens of that allocation, if you're just going to try to own the full investment market basket. And sure enough, what we see in a number of different analyses, I'm showing you one that was done by Morningstar last year. What we find is that we find optimized portfolios showing REITs anywhere between 5 and 15% of a portfolio allocation. Here you could see in the highest risk portfolio, we in this analysis found domestic real estate in the form of REITs accounted for 13% of the portfolio. And what our message as NAREIT goes out is first and foremost that investors need to be thinking about having a commercial real estate allocation in their portfolio, and then explaining why REITs can be the way to provide that allocation. So when we just look at the growth of REITs over time, what we can see is that REITs today account for between 10 and 20% of commercial real estate in the US. So they're providing the opportunity to get access to those commercial real estate investment attributes. And REITs account for about 10% of the overall commercial real estate market and about 20% of the investment grade or high quality commercial real estate market. So, and the other thing I wanted to show with this slide is just the growth of REITs over time. As you can see, back in 1995, when we start this analysis, REITs were somewhere between 1 and 2% of the commercial real estate market. We've seen this dramatic growth in REITs, both in terms of their overall size, but also their share of the overall commercial real estate market over the last 30 years. So then I'll just note, so, as I mentioned, REITs are an incredibly important part of both the commercial real estate market, but also the economy. As I mentioned, we have 145 million Americans living in households with REIT investments. REITs support nearly 3 million jobs and about $85 billion a year in CapEx and new construction. And they're being used by traditional defined benefit pension plans, defined contribution pension plans. Those are the employee-run pension plans, as well as individual investors. Just briefly, sort of the whys. One, it's returns. REITs have systematic.
Sorry to interrupt,
Yes.
John. This is very insightful. I was wondering if anyone from the audience have any question for John.
Yeah, I'd love to grab some questions.
Because we are hearing from the horse's mouth. NAREIT is National Association of Real Estate Investment Trust. And if you have any queries related to what REITs are and why should one invest in them, John is the person. John, with your permission now, I could move to Alok.
Yes, that would be great.
Alok, everyone has been very anxiously watching the stock markets of India. Things have happened in the last few days, but much bigger things have happened for the last 2 years. And since the pandemic, you can see a clear and significant difference between how REITs have performed on the Dalal Street and how the overall stock market has performed. The stock market, Nifty 50 has been all over the place. It has been highly volatile. But when you look at the REITs, they have been growing and growing steadily. How do you manage? How do REITs manage that?
Well, I think interesting and a very obvious question. But so Dr. Das, REITs, as I think John has already talked about a bit, and everybody's kind of aware that they provide returns through distribution of rental income and capital appreciation from the properties they own. And the rental income is based on long-term contracts with tenants, and that is a high visibility of cash flows. Now, capital appreciation may vary, and that can depend on region to region and on time to time. But over long term, I think we can expect it to be in line with inflation. So that makes REITs low kind of a attractive asset class with investors and kind of it's a low risk adjusted investment. Now, when we talk about REITs in India, all three listed REITs have provided a compounded annual return of 15 to 20%. Of course, their history has not been very long, but this return is a combination of about 6 to 8% dividend yield, and rest is through capital appreciation. I think something what I'd like to add here, during the second wave of COVID, there was a bit of an overhang on REITs, and there was a concern that the commercial real estate requirements could go down, and we were always confident that there's no substitute for office. And what has supported our thesis here, most of the commercial real estate developers and all top three REITs have collected 99% of their rentals in last 2 years. Tenants have largely held to office spaces, and they have not surrendered the office spaces. And the occupancies, in spite of 2 long years of COVID, are in kind of a mid 80s for grade A developers and also REITs. And really, what has happened in last 6 to 8 months, as the vaccination has gathered momentum and developers kind of a plan to come back to offices. Today, they are more prepared to handle COVID and more confident. I mean, people are aware that probably this is a third wave and waves will come and go, but people have realized that while work from home is kind of has become more acceptable, but there's no substitute for office.
So
And people
allow
have
me to pick it from there. So what you are hinting at is that there could be some systematic shift in how we have perceived office spaces to be. And as of now, offices tend to be perhaps the most dominant asset class that REITs own in India. And everyone is uncertain about it. What is your view on the future of office? How will the future of office look like? I totally understand that right now, a lot of your clientele, a lot of your tenants are blue chip tenants whose business was not, and that is true of all REITs all over the world. But how do you perceive the office space to evolve over time, given that the pandemic is here to stay?
fair enough. I think I just would like to step back and make a small point. I think the
Please go ahead.
uncertainty is behind us.
Mm-hmm.
Today, when tenants are coming back to offices, they know that there's no substitute for office, and that is one reason why if you really see last three to 6 months, REIT has shown outperformance. So that's something I just wanted to complete, from my last statement. The same time, when we are talking about offices, I think, and it's a fair and it's a very good question, that when we talk about office seats in India or globally in today's time, we cannot do without talking about how the workspaces are going to look like. So what we feel, there are three parameters which are going to define office spaces. One is ESG norms, and other is technology, and third is innovation. And today, in a survey, what we found was that employees are kind of having the most preference for a clean air in the office premises, and that's governed by the kind of the health and safety concerns, and that can change over the period of time. But what we feel is that in offices, the developers are going to provide clean air, high quality filters that can keep the air quality clean and air pollution to minimum. Now, these filters should be able to block bacteria, viruses, and dust, and that's becoming a in thing. So that's one. Second thing is technology is going to play a very, very important role in employee engagement as well as driving productivity. I don't think companies could have done work from home without the use of technology. And the other aspect of technology would be, developers are introducing and they have introduced touch-free sensors, touch-free building interfaces, touchless elevators, touchless exit entry points, and there could be a mobile app that allow users to access amenities and offices through touch of a button. So that's again a very, very important aspect of future office spaces. And third thing I would like to say here, Dr. Das, is in a NASSCOM study, the employees are enjoying flexibility. 73% of employees are enjoying the flexibility offered by technology and work from home. At the same time, 75% of employees are craving to come back to offices. They are craving to have in-person meetings. And innovation is a need for R in office spaces to evolve to the modern needs. And this innovation could be in technology, it could be in terms of architectural design, it could be in terms of operations, and it could have kind of a multiple dimensions. But one clear shift is tenants are looking for campus like developments where they have options to expand. They have large and open public spaces. where they can meet social distancing norms, and they like host of amenities. Employees feel office should be a home away from home. So that's how future offices could involve. It's still work in progress.
I want to kind of Prashant just jump in, because just on piggybacking on Alok's comments about the air filter and all those things that he was mentioning in terms of office building. This we used to have the LEED certification. Now the new kind of the thing that's in thing, which has been kind of accelerated, and John can probably talk about that as well, is the WELL certification. I don't know, it's a very, very new thing. It has been there for a while. It's something that has been new, but has been accelerated by the COVID pandemic, which was this focus on the health of the person working inside the office space. So it's a new certification. It's called WELL, WELL, and you can look into that. It's pretty unique, because now, the LEED certification, it's kind of the same people who started the LEED certification who just focus on the sustainable aspect of the building. Now they are integrating the sustainable aspect of the building, but also taking into consideration the health of the employees that are working in that office environment. So they give this WELL certification to buildings that also incorporate air quality and other factors to reduce absenteeism, because what they're trying to say is the overall well-being of the companies that are working in these office spaces is also driven by the employees. So this WELL certification will also make increase your productivity, but also reduce absenteeism, as well as bring in a more conscious environment of being safe and secure in the buildings that you work. And this is the new thing that is kind of going around, at least in the US, where people are now building not LEED certified building, but LEED as well as WELL certified building.
Yeah, and I guess that is what Alok has also been talking about when he talks about open spaces and home away from home. So just for audience's benefit, I'm going to summarize the points that Alok has made. There'll be more focus on ESG. There will be more focus on technology, and there will be room for more innovation. I'm sure a lot of these leading REITs are already working on that. And Alok, I couldn't agree more, because offices are here to stay, and a lot of uncertainty about how the future will look like may pretty much be rhetoric. If you look at many other asset classes like retail, we know that one of the major online retail companies is going to open physical retail space. So we as human beings want that social life, we want that touch, and there will always be room for high quality offices. And some of the features that you have pointed out is something that only an organized player can easily bring to the market. And that is where REITs will continue to play a role. Vivek, there are a lot of questions for John from the audience, if you would like to address them from your side.
There are a lot of them. I don't know which one to pick. I think maybe to start about, John focused a little bit on performance and other aspects. And of course, he spoke about generic aspects of the REITs and the industry. There are some questions in terms of, how did the hotel REIT class do? And in terms of the allocation of REITs, not in the US, but in terms of in general, how do you think that is being impacted, or in general, how that, as compared to the 13% or 12 to 13% that you were mentioning, what about, do you have some idea about how it is maybe in Europe or in Asia or in other parts of the world as compared to the US?
Sure, Vic. So on the second question, when we do sort of an optimal portfolio analysis, and instead of using US REITs, if we use sort of the global REIT index, which is divided between the US, Europe, and Asia, we find actually very, very similar results, that anywhere up to 15 to 20% allocations to commercial real estate. And I think one of the great things about REITs is for investors, I like to sort of say, one of the real benefits of REITs is they provide a bunch of different forms of diversification. The first is just getting real estate into the portfolio. That's sort of diversification number one. The second is global diversification. So for a lot of investors, they may have a home country bias in terms of their direct real estate. They may like to own direct real estate in their home country, but of course they need to get a footprint. They need to get a more global footprint. So, the US investor needs to get India into their portfolio. The Indian investor needs to get US into their portfolio. REITs provide the perfect venue for that because you're getting a top quality management team, you're getting good corporate governance, and you're getting low transaction costs to get that into their portfolio.
John, last time I read the
Yeah.
regulation in India, Indian REITs must hold Indian-based assets. And I hope this will change in the future as REITs mature over time.
Oh, right. Now I'm talking about for Prasad, I'm talking about for investors, right? So for me as a US investor, I need to have a global exposure in my portfolio. REITs are the perfect way to get that global portfolio. And then the other form of diversification is just by property sector. So you asked about hotel performance, and hotels were one of the hardest hit sectors, certainly, and we're down in that first period of the COVID crisis. Hotel REIts were down over 50% between February 21 of 2020 and late March of 2020. That first month when overall REITs fell over 40%, hotel REIts fell more than 50%. We really didn't see hotel REIts start to recover until after November 2020 when we had vaccine announcements. But since that time, we've actually seen hotel REIts perform fairly well. And over the last couple of months, actually in the US, as we've seen sort of a second reopening play, as Omicron numbers are starting to come down, more and more people, I think, are starting to believe that we've moved from pandemic to endemic phase. We've started to see hotel occupancies rise. We're starting to see business travel coming back. And so we've seen a much stronger performance in the hotel space. But it absolutely, along with retail, that was one of the hardest hit sectors. But one of the real benefits of having this widely diversified set of property sectors. So in the US, retail is about 10% of the market capitalization. Hotels are less than 5%. Office is about 10%. So even hard hit sectors, if you're owning the fully diversified portfolio, you're insulated against them because, well, offices were hard hit, retail was hard hit, data centers performed very well, industrial and logistics, because of the e-commerce play, performed quite well. Cell phone towers performed quite well. So that broad-based diversification really provided investors with some protection over that period.
So audience there, I see a lot of questions that are more generic in nature. In the interest of time, we are focusing on the questions that we would like to shoot to the panelists. And if time permits, towards the end, Vivek and I could try and answer some of your questions. Please go ahead, Vivek.
Yeah, so, it's some great insight into kind of the REIT world. But John, I would like to kind of get into a little bit more of the role of the institution, NAREIT as an institution, because I think that's the direction we want to go, especially considering our audience here and considering the Indian markets, because the next step of evolution as the REIT industry grows in India is to kind of look into the role of an organization like NAREIT. So could you kind of give us what kind of happens when we are in situations like an economic distress, like a shock in the market, maybe like the 2000 dot-com bubble and the most recent one, of course, the COVID, but also, the great financial crisis as an example. What is the role of organizations like NAREIT during these times of economic distress, and how have they helped the industry in general, per se?
So I think those are periods where a trade association, an organization that is trying to represent the industry can be critically important. If I actually think a little bit about what NAREIT has done over just the last couple of years during the COVID crisis, I think it maybe provides a good encapsulation, because we were certainly working with the federal government in the U.S. And with Congress to make sure in terms of COVID support legislation that REITs were essentially not left out. One of the challenges we face is that REITs are a specialized part of the tax code, and you have to make sure when legislators are enacting legislation that they're making sure that it works for the REIT space. So that was one really important focus. We also had to work with regulators and with the Department of Treasury to make sure that REITs were able to access some of the financial support programs run by the Fed and Treasury. That was critically important. But the other thing is really communicating both with our members about what other members were doing. We ran surveys on health and safety, so that our members could understand what their peers were doing and build off of their good ideas, as well as being able to communicate effectively with investors. So one of the things we did very early in the crisis was actually start doing a rent collection survey, where we were surveying our members on their monthly rent collections. And one of the real values of that was that I think in a crisis, in the absence of information, you're very likely to assume the worst. And I think office is a great example. We had a very similar experience in the US as in India, where even though companies were not bringing their employees to the office, they were paying rent, right? So we were finding 95, 96, 97% of rents being paid in the office space, which was something that a lot of investors assumed, well, if the employees aren't going to the office, I guess rents aren't being paid. But that's not the case. The offices were collecting their rents. But also, even in the retail space, what we consistently found was that rent collection was far better than investors assumed. And so by being able to go out, collect data, bring that data to the market, you can bring the level of fear down. And then, as we mentioned, going out talking to investors about the real composition of the industry. We had significant issues in retail. We had significant issues in lodging. People have concerns about the future of office, but it's very clear, it's very important to be able to go out, discuss those concerns clearly, discuss them from a fact-based basis, but also to note that, there's other sectors of the real estate market that are not having performance issues. Some who were, in terms of some sectors of the real estate space were benefiting from the e-commerce boom. So we really view our role as to go out, be data-driven, fact-based, and sort of be able to provide the whole market-based view, and that helps build confidence over time. And I think helped investors understand what was going on in the real estate space.
Yeah, John,
the other piece
I have a very related question for Alok on this.
Yes.
And Alok, some audience members are also asking, Rahul Gambhir is asking, like beyond offices, what kind of other asset classes do you foresee being added to a REITs portfolio in the future?
Yeah, so I think let's talk a bit about India here, because India REITs are at bit nascent stage, and I think once they are able to establish their successful track record, more asset classes could bring out REITs, and they could be retail. I think retail is something we would expect REITs to come in. Again, hospitality, hotels, REITs could come in. Of course, the cash flows, the leases for hotels are for a day or 3 days or 4 days. And for offices, the leases are for, let's say, 5 years or 10 years. So that's a fundamental difference. And of course, data center is something which could behave like office, long-term leases. And India, it's at bit nascent stage. And then warehousing, which is again has a office kind of features, but the size of REITs in data center and warehousing could be much smaller. Or the number of REITs could be much less as compared to office. And we see as the markets deepen, we can see specialized REITs for each asset class and ETFs, and of course that can lead to investors diversifying their holdings, like what has happened in developed markets.
Very good. And Alok, in a way, someday we should dream that we will have multifamily REITs in India as well, because they have been so successful in the US. But of course, we know what the challenges are, and I'm working on some white papers. And Vivek, I would like to bring you on board on that as well, on how to make multifamily REITs successful in India. But
So
because we have both John and Alok in the room here, I think it's a good time to ask Alok about the utility, the efficacy of having a NAREIT-like organization in India. Do you see it happening? Does it interest you? Because, wouldn't REIT want to be included in, let's say, an index? And I know that many of you leaders have been working towards it. So what is your view on
no, I think fair enough, and that's a very valid question. But as you see, India has just kind of a three REITs as of now, and that has happened in last about 2 years. And in India also, if you talk about office REITs, the total REITable properties is about 350 million square feet, and that's growing. Right now, about let's say about 25% of that area has been captured by three REITs. And we feel as markets become deeper, many more REITs would come, and there would be a longer track record. And of course, I think it's a natural corollary that association will form, which will represent this industry. And I think we should also keep in mind that India is almost about 40 to 50 years behind the US markets in terms of REITs and advent of REITs. And with passage of time, as industry mature, I'm sure an organization like NAREIT will come in, and that's required, and it should be able to represent industry and take care of its interests and safeguard its interests.
Vivek?
Yeah, so I think we got some insights into the role of NAREIT, and also I would like to kind of ask John, in terms of NAREIT as an organization, does their mandate kind of change over a period of time, or do they kind of take a look at how the industry per se has gone? Because of course, like Alok was mentioning, we've had 60 years, and kind of we have gone to a kind of mature stage now. So what's next? So how does NAREIT looked into the future to see what NAREIT should be doing as an organization for the REIT industry? And of course, taking these shocks out of the system, let's say in a normal market, whatever way it looks like in the next few years, what do you think NAREIT role will look like in the next few years, and how it has changed? But also, what are the new emerging topics outside of the pandemic and other things that you're kind of looking into the future to say, hey, these are the things that we need to now, since we have matured, and what are we looking into the for the next, to kind of anticipate the next change in the industry, so to say?
Yeah, no, that's exactly right. NAREIT, to be successful, to effectively serve our members, to communicate effectively with investors, we always have to be looking ahead, trying to understand where we can add value, where we can be helpful. One of those places where NAREIT's role has changed dramatically, just over the 5 years I've been with NAREIT, has been ESG, and even within that, our role has changed dramatically. So when I arrived in 2015, I would maybe talk about ESG once or twice a month. Today, it's something we talk about every single day. We now have 3 people at NAREIT who are dedicated ESG professionals, one allocated to environment, one to social, one to governance. We generate several publications per year for our members, supporting their efforts in terms of both what they're doing in ESG, but also critically important, how they're reporting what they're doing on ESG, which is an absolutely critical role. But even within that, the emphasis has changed dramatically. So 5 years ago, people would say ESG, they really meant environment. That was where all the emphasis was. Governance has always been an underlying important factor, both for investors and for REITs. But we've seen the importance of the social dimension change dramatically, and in particular, the importance of having an effective diversity, equity, and inclusion program has really become something over the last really 2 years that has changed dramatically. So the investment framework, what investors are interested in, how they're understanding companies, it's changing more rapidly today than ever, and I think it's going to continue to change. Vivek, I think you mentioned, sort of the well buildings movement. Again, it's not just about what your carbon footprint is, even though we haven't quite gotten our arms around that, but the desire to have a healthy building space, the research that's been done on the importance of the quality of your air for productivity, for our cognitive abilities. This information, it's coming out at a more and more rapid pace. It's getting integrated into investors' desires and needs, and so NAREIT needs to be a step ahead, and that's where we're trying to be in terms of understanding what's going to be critical to policymakers, to investors, and trying to help our members understand that and integrate that into their workflow.
Alok, there's one question that I have always wondered about, and students ask me, and I try to respond, but today is a good day to find an answer, because you have been an expert in private equity space, and now you are at the helm of a leading REIT. If you look at the investor composition, yes, private equity is dominated by institutional big ticket investors. But when you look at the ownership profile of REITs, they also tend to be dominated by institutions. So as a REIT, how do you differentiate from private equity if it's about talking to, let's say, an institutional investor?
So, Dr. Das, I would say that private, and I'm saying real estate private equity here, and a REIT, they have fundamentally different risk and return characteristics. And when we look at pool of capital for REITs, while it's public capital at large, and for real estate private equity, it's a private capital at large, and the cost of private capital is, of course, higher, that we would appreciate. REITs are a liquid investment. They can be traded at click of a button, whereas private equity could be illiquid, and liquidity lies at the time of exit. In REITs, we have regular dividend and capital appreciation, whereas in private equity, real estate private equity, we could have intermittent returns, and they're largely back-ended. So that's one. In REITs also, there's a norms on how much leverage you can take, and in India, norms are about 41% of gross asset value, but most of the companies don't want to go beyond 1/3 of gross asset value. Whereas in private equity, you can have high leverage.
60% is the average in India, I saw.
Yeah, it could be about, even ideally 1/3, 30%, even lower than that. So REITs are driven by stable returns, and in private equity, I think high returns is the criteria. And then REITs, one more fundamental difference, REITs would not like to take a development risk. They would like 90 to 95% of their portfolio should be return generating. Whereas private equity funds can take a good amount of development risk because their aim is to maximize the return. I think fundamentally quite different. Both of I would say both animals are quite different actually.
Right. And there's this issue of transparency as well. That
Oh, absolutely. REIT being listed, there's an issue of the management is subject to much more scrutiny, and they have their limitations. Private equity, investors, of course, they have more free way to how to invest and how to deploy the capital.
Reid, sorry, I interrupted you, Vivek.
No. I was kind of, just kind of thinking about like how in the US the REITs evolved. It's kind of really surprising because when REITs were started, they were always, I would say 95%, probably even very close to 100% mortgage REITs and very few equity REITs. And now it's totally flipped. We have mostly probably 95% or 90% equity REITs and very few mortgage REITs. So that kind of evolution over a period of time, for whatever reason, has happened over here. And in India right now, I think, and correct me if I'm wrong in terms of the compositions, all the three REITs are equity REITs, and there's nobody in that debt space. So I think it would be interesting to see, and I would like to get Alok's perspective on that. Is like, do you see any of the debt side companies coming up, just kind of offer more options for investors?
So Uh, yeah, Vivek, I think good question. But what investors are looking for at least mid-teen kind of returns, and they would expect some distribution of about 7 to 8% and some kind of a appreciation which could be in range of 6 to 7%. I mean, when the people are putting, they want 13 to 15, 14 to 15% kind of a return. So from that perspective, at least we feel that mortgage REITs or debt REITs are a bit far away, and I'm not sure, how much they could be in offering. So that's our sense. But I think once the REIT market matures and there's enough of equity REITs, there could be some interest for mortgage REITs or debt REITs. I think that's something time can tell. But I see more potential of theirs in the multi-family REITs. I think there they could play a more important role. But office, I think, could be equity REITs going forward. That's my sense.
But on that
So,
note,
so it's Prashant, just sorry, because I just want to what Alok mentioned is because he's focusing on the return side, and John has been discussing more on the diversification side. So I think that is important because at the end of the day, yeah, returns are important. So what Alok is for a sense from Alok's comments is that the Indian markets are more focused on the return side and not looking at diversification. On John's, a lot of his PowerPoint and the other comments he made was more focused on driving institutional investors in the direction of diversification as an important tool for investing in REIT. So that's kind of interesting perspective because you have one market which is kind of in an infancy stage focusing on the returns, whereas a mature market is looking more on the diversification. So
yeah,
kind of
that's the benefit of having
interesting.
both of them on board today,
Yeah.
because we can also sort of it's like a time machine, right? That we can see where we could potentially be maybe a few years later, maybe within a decade or so. And but on that note, there has been some movement on securitization of commercial mortgage recently. I mean, yes, we don't have a very big CMBS market, but recently this association was set up by some of the largest lenders of India. They're trying to work on syndicated loans, and hopefully we will get there. Gentlemen, our time for the panel discussion is over. But if you have any last points to make, John and Alok, we know you're very busy, so we won't keep you here. What I propose, Vivek, is that maybe we could spend 5 minutes longer and try to address some of the questions that the audience has posted, if you do.
Yeah, I know there was some question which I answered on behalf of everybody, which was focused on do REITs look like, which is in academics we have been grappling with this issue for decades now, in terms of do REITs look like equities or do they look like bonds, or what are the correlations, which very interesting because they kind of all over the place. So John, if you want to touch on that aspect as to what kind of animal this REIT is, and then what's your sense on that?
Yeah, I mean, I think that there, as you mentioned, there's a lot of academic research on this of sort of what kind of factor loadings you can get out of REITs, and what I like to really emphasize on this question is that when two things. The first is when you take REIT returns and you compare them to private equity real estate returns, private real estate returns, once you get rid of the reporting lag on private real estate, what you find is a correlation between REITs and private real estate that's around 0.9. So the first most fundamental point of REITs is they're providing real estate returns. That's really, I think the fundamental thing to understand about REITs. And then, of course, when you look at their correlation with equities, we find depending on the time period you're looking at, in the US, we find correlations, around 0.5, 0.6. Globally, it can be a little bit higher. But when you look over the universe of potential diversifiers, REITs are always going to be one of the strongest diversifiers, and importantly, they're providing that while they're providing return, right? REITs have over the last 20 years have beaten the S&P 500 in the US. They've provided strong global returns. So I focused a lot on diversification.
Private equity as well, right?
And typically outperform private equity real estate over that same period. So and even one of the things we didn't really talk about much is inflation. Alok mentioned REITs perform well during periods of inflation. We find the same thing. The REITs outperform the broader stock market during periods of moderate and high inflation. And one of the great things about real estate is that both as a diversifier and as an inflation protector is if you're wrong and you don't get that period of high inflation, you still get reasonably high returns because they perform well during periods of low inflation as well as during moderate and high inflation. So, so in terms of this question of how they perform, I think the fundamental piece is that they're performing as real estate, and real estate is a unique asset class. So you can find factor loadings, you can find combinations of debt and equity that end up mirroring them over some long periods. But really, real estate is a unique asset class because it has a unique supply side. So that's why ultimately over the long term and during those important turning points in the market, I don't think you can effectively replicate real estate with a combination of stocks and bonds. So that's a long answer to a short question, but I think fundamentally the key is that REITs are behaving as real estate, and real estate is a unique asset class, which is why portfolios need real estate in them.
John, you were spot on. The academic research has been split, and that split is usually on the timeline. So some of the earlier findings were very different from some of the more recent findings. And I think more recently, they have found some element of commercial real estate and some element of mid-cap stocks, right?
Right.
And I think that is good and bad for REIT. I mean, good in a sense that in India, at least to some extent, it will create a more definitive perception about REIT, that look, this is like as liquid as stock, but it is a stock-like exposure to commercial real estate. And Alok and I were also discussing about this, that sometimes there is this and this is the question that Vivek was asking, that is it bond, is it stock, what is it? And then perhaps again here also, John, it's good to have you with Alok here, because we are able to see potentially where Indian REITs would be, in a few years from now, and it looks pretty exciting to me.
The one place I want to disagree with Alok though is it's not 40 or 50 years behind. No way. You're a lot closer than that.
It's going to collapse.
Okay, fair point.
Right?
Fair point. Yeah, I meant in terms of, okay, that's fair point.
In terms of regulation, yes.
Alok, can
you were
you
more scientific about this, Alok? Yeah. Sorry,
Prashant. Alok, can you shed some light in terms of your ownership, in terms of what is it? How much is institutional versus retail? If you can provide that in terms of your stock holdings.
Yeah, I think that's a good question. So we have ensured that at least 50% is something owned by BAM, which is our sponsor company. So we want to at initial stages, we want to just show that we have confidence in the product, and we continue to own at least around 50% for years to come. So that's a very, very important kind of a criteria. Now, what's the split between retail and institution? That's something I need to check. I can get back on that. That's something,
And to your point, Alok, Vivek, SEBI's regulation mandates Indian REITs to have a larger stake of sponsor for the first few years. So in some REITs go, even further to build that assurance that, look, it's not only the minimum 25%, the sponsor has even larger stake.
Yes, that's an important point I want to
make. Investors. Yeah. So, gentlemen, I think this is dinner time in India, and John has other things to do as well. And Alok, we have been so lucky to have you here. We know you have had a long day. It's perhaps we could say bye to you at this moment.
Thank you. One more small point, Dr. Das. One more small point. I think audience has large number of IMA students, and I think I know IMA attracts best and brightest of minds in India, and what I hope that the kind of initiatives you have taken and the center has taken, that should be able to attract some of the students from IMA in commercial real estate management. That's my wish and that's my desire.
Yeah, and we
That's
would
I just
like
want to
you
make
to
a small
help
point on
us
that.
on that mission, Alok, and we would like to bring you here and get some of our students inspired sometime very soon.
Sure, happy to do that. Happy to do that. Yeah.
Thank you very much, Alok. John, would you like to say something as a farewell?
Again, listen, thanks for having me. It's been a great discussion. Hopefully we'll be doing this in person sometime very soon.
Soon, yes.
We get out and about and moving around the world again. And yeah, looking forward to meeting some of your great students in person. And
we would love to host you here, John. We have to find a reason to bring you here. Would you be going to Florida this year?
For Aries?
Mm-hmm.
I'm thinking about it. I have to check the dates. I know it's coming up, and I got to put it on the calendar. But if you're going to be there, I'm more encouraged to go.
Thank you very much, gentlemen. Thank you very much for your time, John.
Thank you, Alok.
Alok.
Thank you, John.
You're welcome
Thank
to
you so
stay.
much.
But now we are going to answer a few questions from the audience.
Great.
Thank you very much.
Thank you, everybody. Thank you so much.
Thank you. Bye.
So Vivek, I would identify some questions and then maybe we could quickly go over some of them. Sanjeev is asking, how about hotel REIT class? Please.
Well, I think he did mention that. He did mention that the hotel REIT class, they dipped by almost 50% and have not recovered as much as others. And they have started to recover after the vaccine mandate. So they have recovered 30 to 40%, but still not back to what they were pre-pandemic.
Yeah, so even in India, the occupancy rates in hotels in general are not at the pre-pandemic level, but they have sort of plateaued. But if Sanjeev, your question was related to regulation, yes, initially it was difficult to bring hotels under a REIT umbrella because hotel income is not real estate income. So in the US, they solved this problem with the provision of what they call as taxable REIT subsidiary. In India, it should be possible to do it through the SPV structure, but I'm yet to build clarity on how exactly has the regulation addressed this. I remember I had commented this to SEBI a few years ago about this particular limitation that hotels may find it difficult to adhere to some of the rules. Ashish Gupta, our friend, is asking about the percentage of co-working and flexible space in your office portfolio. Sorry, Ashish, perhaps we are a bit late. We have a question okay. So Devraj has a very classical question, Vivek, and I would like you to answer this. He's asking, most of the profits from REITs must be distributed to investors. So how will the REITs grow?
Well, REITs typically, they always, I mean, this is, a very relevant question for REITs, but it has been answered over a period of time because what REITs also do grow by disposition. All right. So they do sell a lot of assets and it's an active portfolio. It's never like that static. And of course, they have other equity offerings as well. But they cannot grow as private equity grows over a period of time, just kind of start taking more leverage and kind of other aspects. So their growth is slow. And again, the idea behind REITs is more about stable income generation than speculative development. So even in the development space, like Prashant was saying, what do they do? Some of these REITs also have a development arm and generate income through development once they have generated, got that expertise, and do third-party development and also property and asset management, which is beyond their own. So there are other ways for them to grow besides just raising more money and all that, which again, the leverage in the US, optimal leverage is probably around 50 to 60% as compared to what Alok was mentioning on 40% in India. But here
is the gap in India. And Vivek, the challenges to Indian REITs are slightly different from the US REIT, because in the US, the distribution rule applies to net income, net taxable income. Here it applies to net distributable cash flow. So in the US, what a lot of REITs do is play with the anomaly between cash flows and income.
Accounting,
although you end up distributing 120% of your income because your cash flows do not take out depreciation, which is a non-cash expense. You are still left with a lot of cash. So you can use a lot of retained earning to grow as well. In India, it is yet to be seen. What a lot of REITs do is go out more often than many other corporations and raise capital externally. And because REITs are so transparent and liquid that they usually don't have a lot of problem with that. Okay, let me see if there are any other questions that you could discuss, Vivek. Please brief about the ownership criteria of property as discussed by Mr. John in the Indian context. Jatin, for some reason, your question is not very clear to me. If you could clarify, I could come back to this. Rahul's question has been answered. Okay, so Ria Arora is asking, how about residential and healthcare REIT? And I could take a part of it. Ria, healthcare REIT is definitely a possibility. Healthcare will have a similar problem in the definition of real estate, because when you pay a bill to a healthcare facility, you're not paying rent. So it is not totally real estate income. And that means that the REIT as a company will have to work around that challenge of breaking up that revenue into real estate and non-real estate revenue, but it can be done. With residential, the problem is more severe, because as Vivek pointed out, REITs have to be a dividend paying machine. And that is why they are favorites of pension funds. The problem with residential in India is that the rental yield
very
is
low, very low.
And
almost not even inflation. Kind of 1% perhaps.
1.5% if you're lucky. And that is why residential REITs require a higher degree of innovation. And someday we will get there. Maybe we can find some nice ideas. If you have some, please share. Ashish has a question about breakup. Srinivasan is asking about how much funds are normally allocated towards development project as against ready rent yielding asset. Vivek, you could talk about the US. In India, Srinivasan, SEBI has clear-cut rules. I think they started with 10% allocation to underdeveloped properties, and now they have increased it up to 20%. But that is the maximum an Indian REIT can do in new development. Otherwise, they have to buy, already rent-generating assets. Baljit Singh has question about health and well-being certification. Would you like to add something about development in the US, Vivek?
Well, I mean, like I said, the development arm of most of these REITs, they kind of are really generating a lot of revenues through third party. But in terms of, I think the question was in terms of the development of, are they talking about the internal development? What was the
real estate development? So how much of the wealth, how much of the capital is allocated to real estate development as asset or as capital investment by REITs? That's what they ask.
Well, again, it depends upon their disposition, right? So again, it's an active strategy. Unless they dispose, they will not be able to build more. But typically they try to stay away, especially the smaller REITs tend to stay away from development because it's more risky and they don't want to kind of get into that aspect, especially if they have to provide dividends. So most of them try to go for lease properties unless they have some, some new projects or expanding into new markets where acquisition is becoming very difficult, which is probably the case right now in some of the markets, some of the more mature markets where there's the cap rates are trading such a low that it sometimes makes sense to build than buy.
I see. Sneha is making some interesting points. Sneha, could you introduce yourself, please, through chat? So she's talking about multifamily REITs. And she says, in her view, it is some time away because multifamily is not an asset class for PEs yet, but the yields are dismal. So how do you think it can be solved? Yes, Sneha is a high yield investor and works for a PE fund. So Sneha, through REIT structure, as of now, with the Modern Tenancy Act, if we come up with a new revision, we could possibly wait for the regulation to change so that the rental yields could be elevated. Otherwise, it seems difficult for me as of now how to make a multifamily REIT work as such. Unless
well, I think Yeah, no, I think, Prashant, I think from there, I think the role that multifamily will play, REITs will play in India will be more on the diversification side than on the yield generating side, where people are investing in those REITs long term to provide a diversification in their portfolio from a volatility perspective rather than from generating returns. I think that's the role, that's the play or plug for multifamily REITs in India, rather than, if, like Alok was mentioning, if they're looking at 13-14% return, that's not going to happen for multifamily REITs unless the development cost is super low, right? Which
Yeah, so
probably is not the
subsidies
case.
could be a part of it. There could be
Yeah.
special target group who could occupy those residences, and then you could get
Yeah.
some subsidized financing from some non-profit or the government. That's a possibility. But we are just thinking aloud at this moment.
Yeah.
Ria is saying, to be more specific, how we will classify REITs. Is it equity, hybrid, all alternative asset? Ria, this is a contentious, it's a debate. In India, when SEBI launched Reits, and Vivek is privy to it, he used to be in India, and you did a paper at that time on real estate mutual funds, Vivek, right? So the original plan was to launch real estate mutual funds. So there was a team at SEBI that was looking at it from a real estate mutual fund standpoint, and then for some reason it did not fly. So then they came up with REIT regulation, and if I'm not wrong, the REIT regulation team still is the fixed income security team, which sometimes may create a confusion among people to believe that REITs are fixed income securities, or they're like mutual funds. Or in my personal opinion, as a student of real estate, I look at REITs as just another corporation which deals in rent generating commercial real estate assets. Vivek, would you differ from this?
Yeah, so in the US, REIT actually classifies as alternate investment group. They're part of it, whether it's direct or whether it's indirect through public REITs. They will come under the alternate investment group category outside of the stocks and bonds. So they are categorized as alternate investment group. Even in the CFA exam, the Chartered Financial Analyst exam, they're part of alternate investment group. So anybody taking that will have to kind of study them as an alternate investment group. And within that, of course, you have direct and indirect and different other kind of types of real estate exposure. But here they classify as an alternate investment group.
But I sometimes find it a bit interesting that when you look at REIT, you suddenly pierce through the corporate structure, and then you look at the assets and investment that the company is investing in. But for that matter, why are not hotels alternative AIV for that matter? So why is it that with REIT suddenly it becomes real estate, but many other asset classes which do not conform to our traditional knowledge of understanding of corporations, why do REITs end up in the AIV bucket? For me, it's not something that.
Yeah, and even here in the hotels now, a lot of hotels coming, being from Vegas, I can say that in hotels, there's a new trend where a lot of these big companies like MGM and Caesars, what they're doing is they're splitting their hotel portfolios into the business and the real estate, and the real estate is now going as part of a REIT. So that the reason for that is a very innovative strategy, because what they're doing is to make sure that during an economic shock, even if the hotel is suffering, the REIT is not, because the hotel is still paying the REIT income or the rent for the asset that they are occupying, and the REIT continues to do well even if the hotel industry per se is not doing that.
And Daksh is asking, does investing in REIT make the investor a partial owner like it does in equity?
It's an equity, yeah. It's equity for REITs, for public REITs. It's just like a stock. At the end of the day, you're owning a stock, but it's just a real estate stock, which is probably providing you more dividends and less of appreciation as compared. And your exposure is to the real estate. So the REITs were originally in the 1960s, Act of Congress, were created for investors to get exposure to real estate and the benefits of real estate without having to invest millions of dollars. Because if you buy a piece of land, that itself is going to be hundreds and thousands. So as a retail investor, you don't have that exposure. So you don't need you don't get the benefits of real estate. But through REITs, you could get the benefits of REITs without investing hundreds and thousands or millions of dollars. That was the whole idea. So
Sometimes this confusion also comes from the fact that in India we say stocks and Reit units, but from an academic standpoint, those Reit units are just like any other stock. And the unit, they are called unit because they don't come from a corporate structure, corporation, but from a trust. So they are called units. But in reality, they are like any other stock. So this is how many academics like to look at Reits. I hope that answers your question. Ladies and gentlemen, this is an interesting discussion. We have Vivek on board, and I'm a student of Reits and real estate as well. But this is 8:30 at night. And I think like many of you, I am starving as well. So if you have any suggestions or questions about the next topic that you would like this event on, please feel free to write to me. My email ID is prashant.d@iima.ac.in. You could also look up Dr. Vivek Shah's profile. Google him. He is a professor and director of real estate at University of Nevada at Las Vegas. Thank you very much. Thank you for your patience. It has been such an interactive and fun session. Thank you.
Thank you, Prashant. Thank you, everybody.
Thank you, Vivek.
Bye-bye. Good night. Good night. Bye-bye.
Take care.